We're now going to talk about arguably the most important content area within the regulations section of the CPA exam. Okay, so that section is going to be entity taxation. Okay, so the entity taxation section of the regulation exam is going to be weighted anywhere between 28 to 38%. So what does that tell us? It tells us that this is going to be very important. It also tells us that we have a lot of work to do. But good news here again is that this is not rocket science. Okay, so we're still talking about taxation, right? The name of the game here is to break this down into a very simplistic approach so that you can visualize everything and thoroughly understand the intuition behind these concepts, right? We want to see a little red light go off in your head where you're like, oh, I see it now. That actually makes a lot of sense. So that's our job to make this work for you. So when it comes to entity taxation, what is important to fundamentally understand is that the hard part is not going to be understanding the different rules, specifically when you're studying each module. Okay, so the real challenge here is going to be breaking out all three of these primary entities that we're about to talk about and understanding the key differences between the big four ticket items that we're going to talk about for each entity. But with that said, the good news is that this is not going to change among the three different entities. So we need to understand the differences and the tax implications for the formation, the taxation, non-liquidating and liquidating distributions, each of our three respective primary entities. So obviously the exam isn't going to tell you, this is the C corporation section of the exam, this is the S corp section, this is the partnership section. Those sickos aren't going to make it too easy for you. There's a reason that CPA designation is going to be valuable, okay? They want to make this exam hard. It's not going to matter if you can get these questions right after studying each individual module. What's going to be important is looking at a progress test that consolidates all of these entities so that you can read a question and immediately identify what entity it is that is being asked and the rules that apply to each of these four items. So we're going to start by talking about C corporations. And C corporations are going to be the most unique in terms of the rules that apply to them. The rules that apply to C corporations are going to be different from S corporations as well as partnerships. And reason being is because C corporations are the only one of our three entities that are taxed as separate entities. So what does that tell us? It tells us that the income that is generated from this corporation is essentially going to be double taxed. So that being said, it's going to be taxed at the entity level and again at the individual taxpayer level. The shareholders are going to pay tax on the dividends received from the distributions, but we'll get there when we get there. So once again, we have four big ticket items that we need to understand for each of our three entities. We need to understand the formation of the entity. We need to understand the tax implications, okay, so the taxation. We also need to understand how dividends are going to be reported as they are distributed, right? So those could be normal dividends, aka non-liquidating dividends, or it could be when we're selling off shop and liquidating the company, all right? So those are going to be considered liquidating dividends. We're going to start by talking about the formation of a C corporation. The name of the game for this chapter is going to break out our big four ticket items. Before we do that, let's take a dive into some of the more miscellaneous topics and some of the things you need to conceptually understand as they pertain to C corps. So it's going to be the company's shareholders that are considered owners of the corporation. This is going to be different from partnerships in that our shareholders are going to be considered partners under partnerships. So a common theme regarding entity taxation is that CPA candidates will need to have the ability to differentiate C corps versus S corps. The primary difference between C corps and S corps is that C corps once again are going to be taxed as a separate entity. So S corporations are going to be taxed as a flow-through entity. We're going to talk about this separately, but essentially what we're saying here is they're not going to be double taxed. All of the income is going to pass through on that Form K-1, similar to what we're going to talk about with partnerships. All right, so it's just going to be taxed every year at the individual level. With that being said, it is critical for C corporations to file their tax returns to the IRS. Okay, so they're going to be paying tax, therefore a tax return must be filed. This is what they're going to be reporting their taxable income on. So this is going to be reported on Form 1120. Okay, so not going to be mission critical for the exam, but just have a general idea that 1120 is going to be the tax return for C corps. Okay, so some of the other miscellaneous quick hitter topics that we need to cover as we continue to compare our different types of entities. You notice this is going to be the only entity that is taxed at the entity level. So how about limited liability? So another beauty about corporations in general, right, either C corps or S corps, is that shareholders are going to be limited to the extent of their liability. So that's not going to be the case for sole proprietorships. And this is a big one that they do test as far as miscellaneous topics go. A corporation is going to be required to file as a C corporation if they have 100 or more shareholders. If they have less than 100 shareholders, they could still file as a C corp, but the rule here is that if they have 100 or more shareholders, they're going to be required to file as a C corp. So that's different from an S corp in that these companies are always going to have less than 100 shareholders. Okay, so now let's dig into the important stuff. We're now going to talk about the formation of this C corporation. So this is item 1 of our 4 big ticket items. When it comes to the formation of a C corporation, this is going to be a scenario where this is either the initial formation of the company, or it could be a situation where new shareholders are simply coming in and buying some equity in this company. Alrighty, so what you need to know for the exam is this. we have two parties that are going to exist within this formation. We have the C corporation itself, obviously, and we have the shareholders, okay? So this is going to remain constant throughout all of our entities, more or less. So when it comes to formations of corporations, regardless of this being a C or an S corporation, ultimately what's happening here is that shareholders are going to be contributing stuff to the corporation in exchange for shares of stock in the company. So that is very vague, right? What is this stuff? This could be cash, it could be property, or it could be services in exchange for equity, okay? So quick exam trick, property is ultimately going to be what we are primarily focused on throughout all of our formation scenarios. We're going to focus on the other two items as well, but property is going to be primarily where they want you to focus your attention. Okay, so that is conceptually what's happening here, right? Shareholders are contributing stuff in exchange for equity in the C Corp. And within that, and more importantly, what they're going to ask you on the exam, as far as C Corps go, is going to consist of three different questions. Okay, so they're always going to ask you one of these three questions. They're either going to ask you to calculate the basis to the corporation. Okay, so what we're talking about here is going to be the basis that the corporation would record for all the property that they are receiving from the shareholder in exchange for shares in the company. They can also ask you for the basis to the shareholder. So what would the shareholder be receiving that we would need to know the basis for? How about the shares of stock? Okay, so the whole point here is that they're contributing this stuff in exchange for shares of stock. So they can also ask you to calculate the basis to the stock that the shareholder would be receiving. And then finally, after that, we're going to need to calculate the gain that would be recognized by the shareholder within this initial formation if there is a gain that would exist. Okay, so those are the three questions, once again, that they can ask. They can either ask you for the basis to the corporation, the basis to the shareholder, or the gain to the shareholder. So now we're going to build a mental map for each of these items, and we're going to break these out one by one and show you how to get to the bottom of each question they throw your way. We're going to create a menu of options, if you will. Okay, so let's address question number one. The basis to the corporation for the property that has been received. So here's the deal. The shareholder can contribute anything to the corporation in exchange for stock, right? But as we briefly mentioned, what we need to focus on is going to be property contributed. So if we think back in our individual tax lecture, when we briefly touched on property that has been distributed, we were talking about property that has been distributed as a dividend. And what do we remember about how that would be recorded for gross income purposes? Property received would be taxed at its fair market value, if this was some sort of dividend or in the form of wages received. But now what we're talking about is property that is contributed, not distributed. So general rule is that property distributed is going to be measured at its fair market value. But the general rule for property contributed is going to be the net book value or adjusted basis. Okay, so the shareholder in reality can once again contribute services, they can contribute cash, but primarily what we're going to focus on is going to be how property would be recognized as far as basis goes for tax purposes within C corporation formation examples. Okay, so no matter what, the trick here is going to be quizzing yourself over and over again with the rules that are going to apply. Okay, so if the shareholder contributes cash or securities, whatever, this is just going to be at its normal value. But if property is contributed by the shareholder, how would the C Corp recognize the basis to that property they have now received? And this is the rule. It's always going to be the greater of net book value of the property received plus any gains recognized by the shareholder or any debt assumed by the corporation that is associated with that property. So I know that might sound like a bunch of words. It's going to make sense when we go through this, but you got to remember this rule. This has to be memorized. This is flashcard city. Greater of net book value of property contributed plus any gains recognized by the shareholder or the debt assumed. So let's run through a couple of examples. Mary purchases 20% of Joey's Pizza Shop in the current year. What did Mary contribute? She contributed property, no surprise. She contributed a building that had an adjusted basis of $80,000, a fair market value of $100,000, and a mortgage associated with the building in the amount of $90,000. It's going to ask us one of three questions. This question is asking us to determine the basis of the property that Joey's Pizza Shop would recognize upon the contribution made by Mary. Okay, so what do we remember? It's going to be the greater of the net book value plus any gains recognized by the shareholder. None of that's going to matter right now. Or debt assumed. Okay, so what's the adjusted basis? $80,000. Mortgage associated with the building, aka the debt assumed, is going to be $90,000, right? So therefore, the basis to the property received for Joey's Pizza Shop is going to be the $90,000, right? 90 is greater than 80. Okay, so quickly running through a similar example, same story here. Only key difference is now the mortgage is going to be less than the net book value. Okay, so we see that the mortgage associated with the building is $70,000. Therefore, the question is asking you for this question number one, the basis to the property received, the amount would be $80,000. Greater of the adjusted basis in this case, or the mortgage, aka the debt assumed, right? So in this case, the adjusted basis would be greater. Therefore, the basis to the corporation would be $80,000, right? Not too bad. We're just getting started. All right, next question they can ask us, pulling out that mental map once again. What if they ask you for the basis to the shareholder? The basis in what? Well, what's happening here? The shareholder's contributing stuff, could be property, could be cash, for shares of the company's stock. Okay, so what we need to understand is now that we are recording the basis to the shareholder for the stock that they are receiving in exchange for this contribution. So ultimately, what you need to ask yourself is, what is the shareholder giving up? You're reading through a question, you're like, I have no idea, I can't tell. Remind yourself, if the call of the question is asking for the basis to the shareholder for the shares received, next thought you need to remind yourself with is going to be, what did we give up? Right, what did the shareholder give up? There are 3 items that a good C corporation formation question would include in this transaction. They'll generally either give up cash, they'll give up services, or they will give up property. So once again, we're going to focus pretty heavily on property, right? So cash is cash. The net book value is generally going to always be the fair market value, right? It's not going to trade, go up or down. We don't worry about that with tax. So cash contributions are always going to be whatever the cash was. Okay, so that's going to be included in the basis for the shares received by the shareholder. Property. Okay, so property, same story. When we're contributing property, the value to what we are receiving in terms of shares is going to be the net book value of that property given up. All right, but here's the thing. It's going to be plus any gains recognized by the shareholder, which we're going to talk about next, minus any debt that the corporation is assuming. So this is going to reduce our basis as shareholders, right? They're taking the debt off our hands. So that's going to be an economic benefit to us. As shareholders, we want a higher basis in whatever it is that we are receiving. When we exit and sell this off, our capital gain is going to be much lower if our basis is higher. So the IRS is saying, hold up, this company is taking away all of your debt, meaning you don't have to pay for this anymore. That's an economic benefit to you. We're going to reduce your basis in the shares that you are receiving in exchange to as much as 0. Okay, so something to keep in mind, if debt assumed by the corporation is greater than the net book value of the property given up, questions asking for the basis to the shareholder for the shares received, we can never reduce this beyond 0. Okay, so AKA we can never have a negative basis in anything. But we're going to address this when we talk about our gains. And finally, another sneaky item that we're going to talk about is going to be services that are contributed in exchange for shares, right? So one day when you have your CPA license and you want equity in this company, you say, I have a brilliant idea. I'm just going to contribute my accounting fees that I would normally charge $50,000 for, right? I'm the company's new CFO. And in order to avoid tax on them paying me, I'm just going to take equity instead. Okay, so the IRS is saying, hold up, you are wrong. You cannot do that. That is going to be a no-go. You're going to be taxed at the fair market value of the services that you are contributing. Or that amount that you are contributing is going to apply towards your basis. Okay, so the exam does want you to know that services contributed are going to be taxed as ordinary income at its fair market value, right? It's also not going to go towards the 80% gains test that we're about to talk about next. If you're freaked out with what I just said, ignore me because we'll get there when we get there. Okay, so for now, let's go through a couple of examples related to the basis to the shareholder in the shares that they are receiving from this contribution. Okay, Big Bad Mary once again is purchasing 20% of Joey's Pizza Shop in the current year. Okay, so property contributed is going to be a building worth $80,000. Fair market value of that building, same $100,000, and the mortgage associated with the building is going to be $90,000. Questions now asking for the basis in the shares received by the shareholder. All right, so we only have property contributions here. So what does that mean? It's going to be the net book value minus any debt assumed by the corporation. Okay, so net book value $80,000, debt assumed is going to be $90,000, but what did we say? You never, ever, ever have a negative basis. Okay, so the reality is, and what we're going to talk about, is that the excess portion of this is going to be recognized by the taxpayer today as a gain. IRS is actually giving a tax break here. Instead of paying tax on this today, the IRS is allowing you to defer this by reducing your basis all the way down to 0. It's only the excess portion of the gain that the debt exceeds that will be recognized today. Right, but for the purpose of this question, they want to know the basis to the shareholder in the shares that are being received. So the answer here would be 0. Scenario number 2, pretty much the exact same thing, only now we're saying that legal services were also contributed by Mary. Normally she charges $15,000. All right, so maybe she's drafting the operating agreement. Maybe she's doing some legal work for the company. Who knows what kind of legal liabilities they might need Mary for running a pizza shop. Regardless, Mary's saying, look, I would normally charge $15,000 for this. I love the idea of being a venture capitalist, right? I want some equity. I want some skin in the game. Instead of paying me today, I want equity in your company, all right? 20% equity for doing my $15,000 worth of legal work. I also get my pretty smile to come with it. All right, so we want to know, how much is Mary going to apply the basis in the shares that she is receiving in exchange for this contribution? The trick here is going to be to attack this one contribution item at a time. Let's just start with property. What do we say about property? This is going to be the net book value less any debt that is assumed by the corporation. So we're going to milk this all the way down to 0. We can never have a negative basis. So therefore, $80,000 minus $90,000, we're going to have a 0 basis and a $10,000 gain, which we'll talk about a little bit more in a second. And now let's move on into contribution item number 2. We have 3 contribution items that are possible: cash, property, and services. Services are also contributed by Mary. What we need to note here is that the $15,000 would be applied to her basis. Something else that we should reiterate is that this would be taxed as ordinary income on her individual tax return. Okay, so what's key to remember here is that this is going to be anything essentially that the shareholder is contributing would apply to their basis in the stock that they are receiving. So how much of this property contribution is going to go towards her basis? Answer would be 0. How much of the services provided would go towards her basis? Answer would be $15,000. All right, so the sum of both of those is going to be $15,000. Booyah, 2 down, 1 to go. Third possible question they might ask related to a crazy scenario is, what is the shareholder's gain that they must recognize today from this initial formation transaction? Okay, so once again, as shareholders, we are contributing stuff in exchange for shares of stock. Okay, so sometimes the shareholder is going to need to recognize a gain from this transaction. When would they do that? We're going to make this really simple. There's 2 ways for them to recognize a gain. We're going to make this very simple. For your exam, what you need to know is that there are 2 ways for the shareholder to recognize a gain. And that is going to be if they receive boot or if they contribute property that has a debt amount that exceeds the net book value of that property. Okay, so for simplicity, we're going to say the 2 ways are boot received or if we have excess debt. And so something else that is sneaky related to this exam, and this is very annoying, but there is an exception to this rule. So there is a scenario where the shareholder would not need to recognize gain, right? And generally what we're going to focus on here is going to be the 80% control test. Okay, so in order for the taxpayer to avoid paying tax on the gain, they must have not received boot, and after the transaction has finalized, they must now own over 80% of the C corporation. All right, something else that's important to note, services contributed are not going to go towards this 80% test. Okay, so focusing in on boot real quick, what does this consist of? This is basically anything other than the shares that they are receiving. So if the corporation also kicked in cash, if it said, we're going to give you some additional securities of a different stock that we own, and maybe we have some Google stock, we don't want this, we're just going to give it to you. Okay, so boot could be cash, could be stock, or it could also be cancellation of debt. All right, so once again, the 2 scenarios for them to avoid paying tax today, or AKA recognizing gain, is going to be if they meet the 80% control test and if no boot has been received. What you primarily need to focus on is going to be the scenarios for them to recognize gain. Keep it simple, people. Ways that you need to remember shareholders recognizing gain for your exam is going to be if they receive boot or if they have excess debt. Let's go through a few examples to see what's going on. So we say Mary, once again, purchasing 20%. She's contributing that same building with a basis of $80,000, a fair market value of $100K, and a mortgage associated with it in the amount of $90,000. Okay, take a look at that. The question is asking for the gain that the shareholder would recognize. This is question 3 of 3. So what did we say? How does the shareholder recognize gain? First of all, they're not going to avoid gain because we know right out of the gate that they are not acquiring over 80%, right? She's only acquiring 20%. She's not going to be off the hook for recognizing a gain. 2 ways that she must recognize gain: if she has received boot, or if she has excess debt. Do you see anywhere in here that she has received boot? I don't. But she does have excess debt. How do we know? The net book value of the property assumed is $80,000. Debt associated with that property is $90,000. For debt that is being taken off the hands of Mary, right? She's no longer responsible for this $90,000, exceeds the book value of this property she's contributing by $10,000. So therefore, our excess debt is $10,000. That's going to be recognized as a gain today. All right, so let's add a little bit of fuel to the fire. Let's start cooking with gas. We're going to make this a little bit more complicated now. In situation, 20%. Okay, that's the amount that's being acquired by Mary. So she's still contributing that building. Basis $80,000, fair market value $100,000, mortgage associated with it $90,000. She also received cash in the amount of $20,000. Question wants to know what's the gain now that she's going to recognize. So we know already that there's going to be excess debt. We just said $90,000 exceeds the book value by $10,000. 2 ways that she could recognize gain. It's going to be excess debt and also boot received. We know that there's excess debt of $10,000, but we also know that boot has been received, right? We know that Mary also received $20,000. That cash received is going to be boot. Now know that the gain recognized by Mary today is going to be $30,000. So not to get distracted, but real quick, let's just run through a scenario. An alternative universe where this question asks you to calculate the basis to the corporation in the property received. The reason that I'm addressing this is because this is a unique scenario where adding the gain that is recognized by the shareholder to the book value of the property contributed is going to matter. Okay, so assuming this was the exact same question, only now it's asking for the basis. What would this be? We know that when it comes to property, it's going to be the greater of the book value of the property contributed plus any gain recognized by the shareholder or the debt assumed. So the debt associated with that property. Okay, so assuming the cash was not involved here, right? There was no boot received. Then we know that the book value plus any gain recognized is going to equate to the mortgage, right? The debt assumed, right? Because the gain would normally be the $90,000 in excess of $80,000, which would be a $10,000 gain. Therefore, the net book value plus the gain would be $90,000. $80,000 plus $10,000 is $90,000. We know that that equates to the mortgage, right? So in this scenario, it wouldn't matter because technically this is going to equal $90,000 either way. But now we have cash that has also been received. So we see here that the basis would be the greater of the net book value plus any gain recognized by the shareholder or the debt assumed. So right out of the gate, we see here that the basis is going to be $80,000. What about the gain? Well, the excess debt is still going to exist, which would be a gain to the shareholder. We just talked about that. So $10,000 would be added to the $80,000, but they also receive boot. Boot received is going to turn into a gain that is recognized by the shareholder today, right? There are two ways that they can recognize gain: excess debt or boot received. Okay, so therefore, if they asked you for the basis in the property contributed to the C corporation in this event, the basis would be $110,000. I just want to go through that because they do throw that in there sometimes. Can get a little bit crazy. Okay, so we've seen candidates struggle with that scenario multiple times, so it is important to understand the intuition behind it.
Booyah! So big ticket item number 1 of 4 is going to be short and sweet. So this has got to be music to your ears because what we're saying for the rules for the formation of S corporations is that they are going to be exactly the same as the rules for the formation of C corporations. So why is that? Because this is how it works. In order for an S corporation to be established, right, when we're registering the corporation or as a corporation of any kind, the company will always first be incorporated as a C corporation. It is thereafter that the corporation can subsequently elect S status. Okay, so this election could be a few years down the line after the company realizes, okay, maybe C corporation status isn't for us. We want the benefits of being a pass-through entity. Let's convert into an S corporation. Or it could be 5 minutes later after the corporation first incorporated as a C corporation, and then they immediately decide they want to be an S corporation. Point being is that the corporation will always first be a C corporation and then subsequently elect this S status. Okay, so on the exam, you're going to see a formation-related question. So don't get spooked if the question doesn't differentiate whether the corporation is an S or a C corporation. The question very well might simply call it a corporation, right? ABC corporation. They might not say S or C. And the reason that they don't tell you that it is an S or a C corporation for a formation-related question is because it doesn't really matter, right? Because corporations are always going to form the same way. Okay, so they're going to be the same. Let's do a quick recap of those rules. Formation-related questions for corporations are going to have 3 questions that they could potentially ask you. They can ask you to calculate the basis to the corporation, the basis to the shareholder, or gains to the shareholder upon the initial formation of this corporation. All right, so basis to the corporation, we're going to focus on that property contributed, right? That's either going to be the greater of the adjusted basis of the property contributed plus any gains recognized by the shareholder, or the associated debt that is assumed by the corporation. Whereas the basis to the shareholder is going to be calculated from one of 3 contributions. Could be that cash contributed, could be property contributed, and how's that going to be booked? That's going to be the adjusted basis minus any debt assumed by that corporation, or it could be services contributed. And if services are contributed, that's going to be measured at the fair market value of those services. Right? If I charge $300 an hour, my basis is going to be $300 on the hour that I contributed. So gains are going to be recognized in one of 2 ways from the initial contribution. And this is all, once again, going to be assuming that the 80% test has not been met. So if we remember, gains can be recognized assuming that boot has been received, or upon the contribution, we have an excess debt situation. Okay, so excess debt, meaning we contributed property with debt associated with that property that is greater than the adjusted basis of that property. Okay, so we went over this heavily in our C corporation formation lecture. If this is a completely foreign language to you, hearing this for the first time maybe, I highly recommend you go back to that C corporation formation lecture and better understand all the details of this stuff, okay? Because this is going to be very, very important and quite frankly, very easy points if you can get this down, okay? So for S corporations, key takeaways here are going to be the same rules will apply as C corporations. Okay, so at this point, we should have a general understanding of what S corporations are, right? We should have a foundation and a fundamental understanding of how these are different from our other types of corporations, those C corporations. So the next detail that we're going to talk about related to S corporations is going to be very easy points potentially, all right? I don't want you to get these wrong.
Pass through entity number 2, we're now going to talk about partnership entities, which is our third and final entity. Okay, so now we're going to talk about a situation where 2 or more partners come together and incorporate this type of entity. So similar stuff here as S corporations, but there are going to be different rules that we need to know for our big 4 ticket items. So we're going to talk about the formation, taxation,
and both non-liquidating and liquidating distributions. Okay, here we go. Moving on into our third and final entity. So this is going to bring it all home, and we're going to wrap up the most heavily weighted component of this exam, which is the entity tax section. All right, so partnerships are going to be, as we said, pass-through entities. So what that means is these entities will be taxed only at the ordinary taxpayer level. Okay, so that means it's not going to be taxed at the entity level. It's going to flow through by way of Form K-1 to the individual taxpayer or the partner, where they will, like S corporations, pay this tax. Okay, so by now we must remember that it is only C corporations that will be double taxed. Okay, so just like our other entities, we have four major components, and those are going to consist of the formation, the taxation, and how distributions will be recorded for partnerships, right? Those non-liquidating and liquidating distributions. So just to stay consistent, as we started with the formation of our other two entities, we're going to do the same with the formation of partnerships. Okay, so when it comes to the formation of partnerships, this is going to be similar to the formation of corporations. However, there are going to be a few critical differences that you must understand, because as we said, it's not about knowing it right now. It's about consolidating all three of our major entities and knowing the critical differences between each. Okay, so firing this off with the formation of a partnership. This is going to be a little bit different from what we mentioned when it comes to the formation of corporations, right? First and foremost, reverting back to corporations and their formation, there's going to be no real difference between whether this is a C or an S corporation, right? The formation of a corporation is a corporation, okay? So in order to be an S corporation, we must first be a C corporation. Therefore, those rules are always going to apply. Whereas partnership rules are going to be a little bit different, okay? Specifically when it comes to the formation of these partnerships. So we mentioned that on the exam, the formation of a corporation is going to come in the form of three different types of questions. They can ask you to calculate the basis to the corporation, the basis to the shareholder, or calculating any gains recognized by the shareholder. Okay, so technically these three questions could be asked for the formation related questions for a partnership. It could technically ask you to calculate the basis to the partnership upon the initial contribution. They can ask you to calculate the basis to the incoming partner, or they can ask you to calculate any gains recognized by a partner. However, what I want to emphasize, and what you should go ahead and double star, is going to be question number 2, okay? Because the majority of formation-related questions for partnerships are going to ask you to calculate the partner's basis to the partnership, aka the equity value that they are receiving in exchange for their contribution, right? This would be the equivalent to calculating the shareholder's basis in the equity that they are purchasing when contributing to a corporation. Okay, so we're going to double star question number 2 because the vast majority of questions related to partnerships are going to ask you to calculate the incoming partner's basis to that partnership. So this is what we're going to heavily focus on. Okay, so for simplicity and for consistency, we're going to attack these one by one, just like we did when we talked about the formation of a corporation. Okay, so for partnerships, the basis and the contributions received is going to consist of cash received and the property received. So we remember for corporations, this is going to be recognized as the greater of the net book value of property received or the total debt assumed by the corporation. Right? That could be the mortgage associated with that property or whatever the debt is. When we're thinking about partnerships, the basis calculation is going to be the contributor's basis or the carryover basis plus any gain recognized by the incoming partner. Okay, so we're simply going to be focusing primarily on the adjusted basis itself in the property contributed. This is often referred to as the partnership's inside basis. And you could think of the inside basis as everything that is inside the partnership. Okay, whereas the partner's basis is going to be considered the outside basis. Okay, so think of the partnership as a house, right? This is the entity. So everything inside the house is everything that, let's say, the house owns. So that is property that is owned by the partnership, or in this case, the house. Okay, so inside the house is considered what is our inside basis. So think of the outside basis as the partner's basis, right? The partner is outside of the entity. It's separate from the entity itself. So when you think of outside basis, think of the partner's basis in what they're receiving from the partnership, right? That equity, right? So they might ask you to calculate the partnership's basis. They might refer to it as the inside basis. Regardless, these are going to be synonymous with one another. So, for example, Connor and Morgan admit Joe as a 1/3 partner in C&M partnership. In exchange for 1/3 interest, Joe exchanged property with an adjusted basis of $100,000 and a fair market value of $150,000 that is subject to a liability of $80,000. So we want to determine C&M Partnership's inside basis for the property contributed by Joe. Okay, so we said the rules for the partnership's calculation of basis is simply just going to be the carryover basis plus any gain recognized by the incoming partner, right? So there's no gain that would be recognized. The adjusted basis that would be carried over would be that $100,000, right? So therefore, that is C&M's inside basis in the property contributed.